Good morning and welcome to the Orlando Real Estate Buzz. We have a special guest today, Jim King. He is the operations manager for Appley Home Loans. Joe unfortunately got the flu bug that's going around and kind of kicked him on his butt this morning, I heard. So happy to have you, Jim. Thank you for joining us this morning.
Absolutely. Happy to be here.
And we actually got quite a bit of news. We got a big surprise this morning with the CPI number. So we're going to go through a little bit of that. But one of the other items I think we're going to reach out and talk about is the hopes, and you hear it all the time, of the Fed cutting their rates, kind of slowing down the market. Have we kind of hit a paralysis based on hope? And I think getting into these CPI numbers this morning, that we're going to see maybe a lot of it's wishful thinking, really.
Right.
You know, because when we look, they were expecting a 3.2 this morning, and we came in a little bit hot at 3.4%. And Powell says that they are going to hit their target. So when you look at that, Jim, what does that tell you? When do you expect to see rates cut? What's your gut?
My gut says, Q3. I know the market is basically priced in a March cut at this point, or at least the likelihood of it. And frankly, I think it's 6.5 cuts that they're pricing in this year. And I don't see it. I know that people are really wanting it. Both on our side, both on the consumer side, everywhere. Everybody wants it. But Powell has maintained that they're going to get their 2%, and he's not going to let the same thing that happened in the 80s happen again.
Exactly. Which I know you weren't around at that time quite yet.
Almost.
I was. I was actually high school, just starting college, and what had happened was they had kind of inched up rates, very similar to what Powell had done. And we saw an initial decrease in inflation. And they thought, oh, well, okay, well, we'll do a little rate cut. The minute they did the rate cut, inflation shot back up. And that's when Volcker went, okay, nope, we're going to shut it down. We're going to shut it down now. And they went up to 18% on the Fed fund rate, and it crushed a lot of stuff, but it definitely crushed inflation. Right. And I think that's, and I can see Powell understanding that and looking at that and thinking, no, if I have to keep them, and he said it repeatedly, if I have to keep them higher longer, I will.
Right.
Do I think they'll do a increase off of this? I don't think so. But I think they may look at this, and you're saying Q3. I'm thinking maybe July. And I think a lot of that will have to do not only with this number, but also our jobs numbers.
Yeah, which also came in today stronger than expected, right? People are not losing jobs as quickly as people are expecting that they would.
Yep. There was something interesting that I saw in the numbers on the jobs, in that even though we're increasing jobs, the number of full-time positions over last year has actually dropped 1.5 million.
Yeah, a ton. And if you look at the last 6 months, it's even more than that, right? The last time that I looked at it with the last week's numbers, it was something like we had gained like $3 million or 3 million part-time jobs, but lost like 2-point-something million short-term in the last 6 months. So it's like, we have those gains 7, 8, 9 months ago, that as those roll off and you look into the yearly figure is going to start looking worse unless something turns around in the job market.
Yep. And you're right. People aren't moving jobs because they don't have the ability to jump like they did during the pandemic.
Right.
So, and what's interesting with this number is, guess what's driving this inflation like it has pretty much the past year and a half? Shelter.
It's shelter, and it makes no sense, for anybody that watches these numbers closely. Like, what the Fed's looking at, right? They're looking at
Mhm.
what people are currently paying versus what they were paying, a while ago. But they're not necessarily focusing on new rents. They're focusing on old leases, right? Whereas new
Yep.
leases, we're not seeing 19% increases year over year. Like, we're just not. In a lot of areas, we're seeing decreases around here. Like, I'm in Michigan. A lot
Okay.
of markets around here are down maybe 5% year over year. You would expect that to be showing in the CPI numbers and the Fed's numbers, but they're still showing massive increases because of the methodology that they use behind their calculation.
Correct. Yeah. Yeah. Here in Florida, you're seeing rental price decreases. I had 3 rental listings in the past couple months, and we ended up having to drop the rental rate request on all 3 of them because we just weren't getting the flow. Previous year, one was at 1850. This year, we actually came down to 1750. So, and we've in every single one of them, we saw that. And I know currently they're showing that the numbers occupancy rate is only running about 80% on most complexes right now. And
Yeah,
we've got thousands of new units that are
yeah,
going to be coming online this year in the Orlando area.
yeah. I
So how
think
do you fill up all these units?
right when you already have declining prices, you already have lower than trend line vacancies, like, or opposite of vacancies, fulfillments, I guess. But and it's the same thing here. It's not just a Florida thing. That is all over. We're seeing a huge number of multifamilies that people got this extremely cheap financing over the last few years, and now you're seeing a huge amount of multifamilies come online that where you're going to need a lot of people to fill a lot of units.
Yes, you are. So when we look at this, you and I were talking about where do we expect the Fed to go? And this is where I think you and I were talking a little bit earlier. The markets just don't make logical sense anymore. So we're looking at March. This is the Fed tool. Basically, it's kind of like a prediction of where people think the Fed is going to go. And last week or yesterday, we were at 64%. Today, we're actually jumped to 67% that they're going to have a quarter point rate decrease in March. And it's like, wait a minute, inflation just went up, and you think he's going to drop the rates.
Yeah,
That's
it's one of those.
how it usually works.
No, I mean, there's in my mind, there's two possibilities there. One, people are well, three possibilities, I guess. One, the markets are just out of touch, right? Traders are just going wild right now. And that's probably the most likely scenario, if I'm being honest.
Mhm.
Another option is that people are really expecting something bad to happen, which is hopefully that doesn't, right? But I mean,
Yep.
last spring, we saw Silicon Valley Bank. We saw a lot of banks really hit a tough stretch, and the Fed basically had to put a band-aid on the market in order to stop things. But we saw a sizable decrease in rates for that. So maybe
Mhm.
people are expecting something like that again this spring. And then the
Yep.
last option is people are really expecting inflation to come down hard over the next 2 readings. We have 2 readings now between now and that meeting because it's at the end of March.
Yep.
But and if you look at the numbers, a lot of that shelter inflation does start coming off in the next few months because of their methodology. So
Yep.
maybe people are looking into that and trying to front run it, but it's very
Yep.
aggressive thinking that they're going to cut in March at this point, I think.
Yeah. It's interesting. Your second point, I think one thing that may be people may be looking at that a lot of people don't know about, it's called the reverse repo market.
Mhm.
And we've seen those funds in the reverse repo. Basically, if you don't know what it was a bunch of money the Fed printed back during COVID that was kind of there to help the banks, um, have liquidity. It was around $2 trillion. Well, that has slowly and steadily decreased. I didn't get a chance to check it this morning, but the last I think we were down to 800 billion.
I think yesterday was like 660 or something like that.
That's
It's
what it was?
down.
I
It's
didn't
insane.
realize it dropped that much. Okay, so when that money dries up, which with projections, I believe is the end of February, beginning of March, there could be a huge liquidity problem for banks because they've got nowhere to go to get liquidity anymore.
Yeah.
And that could be what people are looking at is what happens if the reverse repo window just shuts down. And it's
The flip side to that coin, and this is I mean it's the same idea, but it's kind of, the implication of that is people are saying that most of that reverse repo money that's being taken out of that facility is being used to purchase the surplus of treasury issuance right now, right?
yes.
So now
Yes.
you have, the treasury issuance, for the year is it's not going to go down, right? I mean, with rates as high as they are, we need to finance all of that interest. So if that reverse repo money runs out, where does the money come from to absorb the new issuance?
You know what they
And
have to do? Money machine.
yeah,
They will have to start printing again.
right. And that
We'll
all of a
absolutely
sudden you're
start
seeing
printing
people
again.
talk about the end of QT or tightening because of that.
Yep. Yeah. So there's a lot of things going on behind the screen that just nobody talks about. They don't talk about it, and it gets frustrating because you know, like me, we watch all this, because one I think we both find it fascinating, but two,
Absolutely.
it truly affects our industry on a daily basis and can change our whole market overnight, literally overnight when something goes wrong. And then this all kind of goes into what we were really going to hit on initially today, which is the hope of those quote 6 cuts that people have priced in, has that stalled the market? Because are people thinking, oh well, the Fed's going to cut rates, the Fed's going to cut rates, Fed's going to cut rates, we'll be back down into the low fives by mid-year, latest is September, so I'm just going to sit there and I'm going to wait. And you get headlines like this from CNBC. Mortgage demand jumps nearly 10% to start the year, even as interest rates tick up. It's clickbait.
Yeah.
It's nothing more than clickbait. 10% sounds phenomenal. But then when you come back and you look at the graph, it's nothing.
No.
It's minimal. And that's what people have to realize is this is the application level back in 2017, 2018. And back then, 2018, I bought my home here, and I think we were at 5.25. Okay, back then. But the prices were also half of what they are now. So people were readily going out and buying homes. It was a consistent market. Then you see the spike from the pandemic when rates, dropped to the 2s and 3s, and everybody's out trying to get a loan. But look at this avalanche. I mean, literally right off the cliff since the end of the pandemic as rates started to go up. So 10% sounds great, but are there really a lot more buyers out there? No, they're not.
Great.
So as a seller, and we'll see this when we get into our Orlando numbers, is days on market are going up. Price cuts are going up. The initial listing prices are coming down. And this is something I found absolutely fascinating. U-Haul comes out every year with a list of where everybody moves to, the top places. And 6 of the 25 are in Florida. You got Palm Bay, Ocala, where's our next one? Kissimmee, St. Cloud, Panama City, great beaches, Lakeland. So you've got a number of places that people are still moving to. But then CoreLogic comes out yesterday with the U.S. housing pricing information. And look where the top 4 places they are predicting price decreases. Palm Bay, your number one place people are moving to, is predicted to be the number one spot for price decreases, the market to fall down. And they're saying there's a 70% probability. West Palm Beach, Delray, Tampa, which was absolutely exploding during the pandemic, and then Deltona and Ormond. Can you help me make a little logic out of that one?
It honestly, it's wild, right? If it was the U-Haul data is looking literally at people moving, right? So that should negate the whole concept of it being a speculative craze that everybody was buying investments and Airbnbs and all kinds of things in those areas that are more susceptible to price corrections, right? If people are actually moving there, that should be the least likely to have crazy declines in prices, because primary homes are the least susceptible to that. So honestly, top level, it doesn't make sense. I would love to hear from CoreLogic, their methodology behind it, because on its face, that just doesn't make sense to me.
Yeah. I mean, it's like, how do you explain that to someone who's moving to Palm Bay? It's like, yeah, you're the fastest growing city per se, according to U-Haul, but your prices are about to drop. That's a good one.
Right.
That one I haven't had
Yeah.
to do before.
Would love
But
to see the equation behind that.
Yeah, but it's just kind of interesting, because it just goes to show you how uncertain our markets are.
Absolutely.
It really does. So let's get into our Orlando numbers, because we're going to see that this is where we're still a very slow market overall, is where we're sitting right now. So hold on. Okay. So when we get into our single families last week, this is the first week of January. So we did lose one day for holidays, but we dropped to 191 homes from 321 at the end of the month. And our inventory, which I expected, is usually right after the first people start putting their houses back on the market. So we went, after a couple of weeks of declines, our inventory went back up. But here's the one that's just crushing Orlando, and I think it's going to be an extremely tough year if you're a condo owner and you're trying to sell, especially the investors. The sales of condos, townhomes, and villas dropped to 82. You think about how many units we have here in Central Florida, in the Orlando region. That is nothing. Absolutely nothing.
No.
And our inventory increased another 55. So you look at that and you're like, wow. And one of the things we always get into is the original to final, and the original list to the final sales price. And you see here, we're still down at 94, mid 94%, 94.61%. So there's roughly about a 5.5% off the original list price.
Wow.
Of homes. And they're still coming in at roughly about 2.5% off the final list price. So sellers are out there giving concessions to people. And I always love looking at over $1 million. They're dropping on average $120,000. They're dropping almost 9% on their original list price to move them. And then our days on market, we have seen, again, a slow, steady increase. And I think at least through March, we're not going to see this number fall at all. I really don't think we are. And then you see it here graphically. And last year, we were at our period average was up in the 400s. So they adjust this every week. and you can just see, look at this drop from here's December 272, 348, 361, 321. And we dropped to 191. That's a big drop.
That's a
And then
huge drop.
days on market, holding up there. And then we
You
get
really
into
hope
our
that bounces back after this holiday week. I guess we have another holiday coming up too, but you got to really, if that doesn't, that's scary.
yeah. And again, the word for this year is truly going to be affordability. Affordability. I don't know if you follow Unusual Whales. Sometimes they have some of the best statistics that come out there. And last week they had one that interest rates either have to drop to 5.5, prices have to come down 22%, or income has to go up 28% in order to make houses affordable again.
Yeah, back to that trend line.
I look at it. Yeah, I look at it. I'm in a 30-year. I'm in a 20-year mortgage with a 3% interest rate. Even with what I would make off this home, I couldn't move.
Same.
I'm locked.
I'm absolutely. I'm stuck here. I've been talking about this, with friends for months. I'm in a condo here in Michigan and would absolutely love to not be in a condo. But it's one of those things where, I would literally have to buy a place, half the price of this in order to have a similar payment.
Yep. And the incomes they're not growing that fast, and they're never going to grow that fast. Ever. And then again, you see our trend line. Our period average last year was around 175. 82. That just blows my mind. And this week, I've got a client. She would like a condo, and I've had to go because it's January. All the condos up their fees, their HOA fees in January. So I've been trying to get a hold of the HOAs. That's joyous in itself. I actually had to go knock on and go to some of the offices yesterday to get the answers, and all of them are increasing their rates. There's one that she really liked. Escondido, it's a 55 plus. It's right here in Altamont, well-maintained property. It's a 55 plus, and they're increasing their HOA fee from $497 to $600 a month. They took out a $3 million loan back in July. They have a $138 quarterly payment for 2 years to pay for the interest. And then on top of that, are you sitting down? They have a $14,000 special assessment coming due. $14,000. And these are people, the average age in there is probably 70. These are people on a fixed income. Can you imagine the shock that they got? $14,000 special assessment. Of course, they can break it out over 10 years if they want to.
It doesn't work. It's just that doesn't for a fixed income family. I mean, they can't.
Nope. So I think we're still in that, not sure where this market's going to go. We just too many things pulling in too many different directions. I mean, we didn't even get into what's going on in China, over there with another bank failure. What is it? They got 2 years worth of inventory if they don't build another house in China.
Yeah. And it's wild because they have just cities that are half built construction already, right? Like there is so much supply that could be ready in 3 months if they wanted it to. And they're sitting off on it. Developers are going bankrupt left and right, which is jeopardizing the banks. It's dire over there. For lack of a better word, it is dire.
Yep. So at least we're not at 2 years of months of inventory.
Right.
I guess that will be our optimistic point to end on today.
we'll take our 44 days on market or whatever that shows.
Yes, yeah. I'll take the 44 as opposed to 2 years. Any day of the week. Any day of the week. Well, thank you, Jim. I really appreciate you joining us this morning and helping fill in for Joe. It was a pleasure. You're welcome back anytime. Take care. Have a great day.
Thanks, guys.